Welcome, finance enthusiasts and the curious alike. Ever wondered about the groundbreaking moments that have shaped the financial world? From the bustling stock exchange floors to the quiet hum of a digital trade, the world of finance is a thrilling spectacle, a chess game on a global scale. It's a world where fortunes can be made or lost in an instant, where the bold and the brave make their mark. We're embarking on a journey to explore some of the most significant moments in financial history, moments that have left indelible imprints on the financial landscape. We'll delve into the tales of remarkable trades, where individuals and organizations made bold moves that forever changed the game. We'll also navigate the tumultuous seas of market closures, revealing the reasons behind these dramatic pauses and their far-reaching consequences. With that said, prepare to dive into the fascinating world of finance. Our first stop takes us back to 1992, where an investor named George Soros made a daring move. Picture this. The year is 1992. The British government is fighting to keep its currency, the British pound, within the limits set by the European Exchange Rate Mechanism, or ERM. Enter George Soros, a seasoned investor with an uncanny knack for spotting opportunities in chaos. Soros and his quantum fund believed that the British pound was overvalued and that the UK would have to devalue the currency. So, he made a bold move. He decided to bet against the British pound. A decision that would come to be known as one of the most audacious financial plays in history. Now, this wasn't a small gamble. Soros risked $10 billion, essentially betting that the British government would fail to keep the pound within the ERM's limits. The risk was enormous, and the stakes were high. But Soros, ever the astute investor, trusted his instincts and held his ground. Then came September 16th, a day that would forever be known as Black Wednesday. The British government, unable to keep the pound within the ERM limits despite its best efforts, was forced to withdraw from the ERM. The pound was devalued and Soros's prediction proved right. The result? Soros's quantum fund made a profit of around $1 billion in a single day. Yes, you heard that right, $1 billion in a day. This daring move earned Soros the nickname, the man who broke the Bank of England. It was a play that demonstrated the immense influence that one investor could wield on the global financial stage. But it was more than just a successful investment. It was a lesson in risk-taking, in trusting one's instincts, and in the power of strategic decision-making. It showed the world that sometimes, going against the grain, betting on the unexpected can lead to unprecedented success. Soros's audacious move forever etched his name in finance history. Imagine a world where the New York Stock Exchange closes its doors for months. Sounds unbelievable, right? Well, it happened in 1914. Let's rewind to the early 20th century, a year that would become a landmark in world history, 1914. The world was teetering on the brink of a catastrophe that would later be known as the First World War. As countries began to mobilize their forces, the financial markets went into a tailspin. Fear and uncertainty ran rampant, causing panic among investors. In response to this chaos, the New York Stock Exchange did something it had never done before. It shuttered its doors and halted trading. This was not a brief pause or a momentary hiccup. No, the NYSE would remain closed for a staggering 4.5 months, marking the longest shutdown in its history. The decision to close was not taken lightly. It was a desperate attempt to prevent a complete financial collapse. The war had disrupted international trade, causing a massive drain on gold reserves. This threatened the very foundations of the monetary system. It was hoped that by closing the exchange, the outflow of gold could be stemmed and a financial disaster averted. Over the next few months, the exchange remained eerily quiet. This was a stark contrast to the bustling activity that usually defined Wall Street. But behind closed doors, work was underway to stabilize the financial system. Finally, on November 28, 1914, the New York Stock Exchange reopened its doors. But things were far from normal. The exchange operated under strict regulations to prevent the excessive speculation that had contributed to the panic. The 1914 shutdown was a stark reminder that the financial markets are not insulated from global events. It demonstrated the interconnectedness of the world economy and the vulnerability of markets to geopolitical events. After all, when the world sneezes, the markets can catch a cold, or in this case, they can shut down entirely. This unprecedented event proved that markets are not immune to global events. Fast forward to 2020, a year marked by a battle of the oil titans. The globe witnessed an unprecedented oil price war between two powerful nations, Saudi Arabia and Russia. The conflict, which would go on to shake the oil markets worldwide, began as a disagreement over oil production levels. Saudi Arabia, a leading member of the Organization of the Petroleum Exporting Countries or OPEC, proposed a cut in oil production to stabilize falling prices due to weakened demand. The proposal was a direct response to the economic slowdown triggered by the COVID-19 pandemic. However, Russia, a non-OPEC country, rejected the proposal, leading to the start of a fierce price war. The Saudis retaliated to Russia's refusal by announcing a significant increase in oil production and offering substantial discounts to its customers. The strategy was clear: flood the market with cheap oil and force Russia to capitulate. Russia, not one to back down, responded in kind. They ramped up their own oil production, leading to an oversupply of oil in the market. The result was a drastic drop in global oil prices. In April of 2020, the West Texas Intermediate, a benchmark for U.S. oil prices, even slipped into the negative for the first time in history. The fallout of the oil price war was felt worldwide. Oil-dependent economies suffered, and the energy sector took a substantial hit. However, consumers enjoyed lower petrol prices, a small silver lining in a generally bleak scenario. After months of intense competition, the two countries finally agreed to a truce in April 2020. They, along with other major oil-producing nations, committed to cut oil production by nearly 10 million barrels per day. The agreement helped to stabilize the oil market somewhat, but the impact of the price war continues to be felt to this day. This trade war underscored the power of strategic decision-making in finance. It was a stark reminder of how national strategies can ripple through the global economy, affecting everything from big corporations to average consumers. It was a lesson in the interconnectedness of our world and the delicate balance that keeps it running. Still in 2020, but this time it's about a sudden market crash. Let's dive into the tumultuous period of March 2020, when a pandemic-fueled fear sent shockwaves through global stock markets. The novel coronavirus, COVID-19, had begun to spread globally, and uncertainty was the order of the day. As countries scrambled to contain the virus, economies worldwide came to a screeching halt. This abrupt stoppage of economic activity led to a sense of panic among investors, triggering a rapid sell-off in markets around the globe. The Dow Jones Industrial Average, a barometer of American stock market health, plunged by over 2,000 points in a single day on March 9th. This was the most significant point drop in the history of the Dow, surpassing even the tumultuous days of the Great Recession in 2008. The sudden market crash was not limited to the United States. Stock markets from Tokyo to London felt the tremors of investor panic. The fallout was immediate and severe. Millions of people saw their retirement savings dwindle, businesses went bankrupt, and unemployment rates soared. The world was in the throes of a health crisis and a financial crisis at the same time. A double whammy that left many feeling hopeless. But amidst the chaos, governments and central banks worldwide sprang into action. They slashed interest rates, pumped trillions of dollars into economies, and implemented unprecedented stimulus packages. These bold actions aimed to stabilize the financial markets and prevent a complete economic collapse. The market did eventually recover, quicker than most had anticipated. By August 2020, the Dow had recouped its losses and even reached new heights. This recovery was largely fueled by the tech sector, with companies like Apple, Amazon, and Microsoft leading the charge. Yet the 2020 stock market crash serves as a stark reminder of the volatility inherent in financial markets. It underscores the fact that markets are not immune to global events, and that uncertainty can lead to drastic fluctuations. It's a testament to the resilience of economies and the power of swift, decisive action in the face of crisis. A stark reminder of how swiftly markets can change. From audacious bets to market shutdowns, these moments serve as powerful lessons. They remind us of the boldness of strategy, the necessity of risk management, and the impact of global events on the financial markets. Every remarkable trade, such as the daring bet against the British pound, underscores the importance of knowing when to seize opportunities and when to step back. It teaches us that sometimes the biggest rewards come from taking the biggest risks. Market shutdowns like the one in 1914 and the stock market crash of 2020 illustrate the interconnectedness of global events and finance. They serve as stark reminders that the financial world does not exist in a vacuum, but is deeply intertwined with political, social, and health scenarios around the globe. These are the stories that shape the world of finance. Until next time, stay curious and keep exploring.